Today, I'm going to build the case for why gold is in a multi-year bull market and why any dips in the price of gold are buying opportunities. None of this is financial advice, but I want to share with you what I'm seeing. When you look at this chart of the US 10-year Treasury yield, you're not just seeing interest rates, you're seeing the rise and fall of confidence in the global financial system. I'm going to break this all down for you today so this will all become clear. The three things I'm going to focus on today are the key ingredients to a major financial reset: an unsustainable debt, compound interest, and war. From the Cold War to the debt crisis of today, this chart tells a story that's repeating, one that shows why gold is entering a new powerful bull market. In 1945, when World War II ended, countries didn't automatically just trust each other. There is an underlying and lingering mistrust. Let that set the foundation for this story. The US became the foundation of the world's monetary system and held around 60 to 70% of the world's gold at the time, about 20,000 tons of gold. In 1947, the US entered a Cold War with the Soviet Union, which is essentially fighting without bombs and bullets. Instead, it uses economic pressure, propaganda, espionage, and proxy wars, essentially fighting in secret. In some ways, it's worse than a conventional war. People will smile at each other but stab you in the back. They'll create chaos from within your own country and turn your own people against you. Consider this festering in the background over the next 80 years. In 1957, the US made its first interest rate cut as it emerged as the leading world power of the time. It was powerful enough not to hold itself back from easy money anymore. This is the start of the loss of confidence in the monetary system. Countries around the world began to exchange their US dollars for gold from the US in record numbers over the next decade. As the US gold reserves were drained down to 8,133 tons of gold in 1971, the US stopped the bleeding by detaching from the gold standard, cutting the dollar's final link to real money. At that moment, gold traded around $40 an ounce. This stopped foreign countries from draining the US gold reserves and replaced it with paper fiat currency. The US was the strongest military at the time, so no one could stop them. As the dollar became a purely fiat currency, inflation surged, confidence eroded, and investors fled to hard assets. Gold exploded from $40 to $873 an ounce in just 7.5 years. That's a 2,182% gain. At the same time, the US 10-year Treasury yields skyrocketed from about 6% to nearly 16%. Now, normally, when the percent yield rises, gold falls, because investors would rather earn interest with the US Treasury than hold a piece of metal that doesn't give back any interest whatsoever. So when percent yields and gold rise together, that's the signal. It means investors are losing confidence in the entire monetary system. That means the people with big money are betting that a 0% interest rate piece of metal is going to be more important than earning free US dollars in interest. Remember, the big money got rich because they're smart. They're going to put their money where it's safest. They demand higher yields to hold US debt, and they buy gold as protection from that same debt. After yields peaked in 1981, interest rates began a 40-year decline. I think this happened because the US military grew worldwide, so the opposing nations went dormant, biding their time to strike. Every crisis that followed, from 1987 to the dot-com crash to the 2008 financial crisis, was met with the same playbook: lower rates, more money printing, and bigger debt. This is the creation of fake money. This can only happen so many times before the other world powers take notice and start to plot against the US. Even though the Cold War supposedly ended in 1991, that mistrust between East and West never went away. It simply went quiet. Remember, some people out there hold grudges for years. Now consider trust not just from person to person, but from country to country. When 2008 happened, it changed everything. The world watched the US financial system nearly collapse under its own greed and leverage. That was the moment global confidence cracked. The realization that the US could not be trusted to responsibly lead the world's monetary order. Out of that came BRICS in 2009. That's Brazil, Russia, India, China, and South Africa, an alliance designed to build a counterweight to US financial dominance. By 2013, China began militarizing the South China Sea, a clear signal that it was preparing for both economic and militaristic confrontation with the US. Then came COVID-19, the pinnacle of easy money. Trillions were printed out of thin air, flooding markets, propping up spending, and pushing debt to levels the world had never seen before. Whether it was planned by the US to enact more control over its citizens in preparation for war, or whether it was a plan abroad to force the US into printing more money to push further into unsustainable debt. The result was predictable: inflation, asset bubbles, and a global economy addicted to free money. In the midst of the pandemic in 2022, Russia attacked Ukraine, marking not just the start of a new war, but the official beginning of the end of US hegemony. Then, while the world was losing confidence in the US financial system, how did the US react to Russia attacking Ukraine? It seized $300 billion of Russian sovereign assets. That public move makes it unmistakable that the world cannot trust the US to be the leader of the monetary system. You'll notice in the chart that in 2022, the 10-year yield broke above that red downtrend line. That confirms the breakout of a 40-year downward trend at the same time that the US debt is at an all-time high and wars are breaking out to challenge US dominance. That's no coincidence. The global community saw the confirmation of the dollar-based system being politically weaponized, something that could no longer be trusted as a neutral reserve currency. Shortly after, in 2023, came a quiet but world-changing event. Basel III banking standards became official, recognizing gold as a Tier 1 asset once again. That means gold is now considered as safe as cash or US Treasuries, a clear sign that central banks are preparing for a world after the dollar. The US was founded in 1776, and it took more than 200 years to accumulate debt up to $1 trillion. Now get this, the US was at $37 trillion of debt back in June 2025. It's now over $38 trillion in October 2025. That's $1 trillion in just 4 months. Let that sink in. $1 trillion in just 4 months when it took the US more than 200 years to accumulate its first trillion. See how much faster it's moving? I've just made it undisputable that the US debt has risen to astronomical levels and that war isn't just a theory, but it's become a reality. Now let's talk about the silent killer in the system: compound interest. Back in 1981, when US debt was around $1 trillion and interest rates were about 16%, the annual interest cost was roughly $160 billion. Today, the US owes over $38 trillion. Even with yields around 4%, the annual interest cost is roughly $1.5 trillion. That's nearly 10 times larger, even though rates are 4 times lower. That's the power of compounding debt, and it's only getting worse. Of course, not all US debt is paid out at the same rate of the 10-year yield, so this is to illustrate the magnitude of the change. If the US ever stopped printing money, the whole system would collapse. So if the US keeps on printing money, then what does that mean for the price of everything? Prices will continue to rise, including gold. If current trends continue, by the end of this decade, I foresee the US debt reaching $65 trillion. If 10-year yields rise to around 8%, that would mean over $5 trillion per year in interest payments alone. The compounding interest then just gets worse and worse, stacking on top of itself year after year, making the debt go up faster and faster. As the US enters new direct conflicts and ramps up defense spending, the need to print even more money will only accelerate. That printing will be the catalyst, the spark that fuels the next decade-long bull market in gold. The principle of compounding interest and rising interest rates creates a mathematical certainty that this will happen. Since Basel III, gold has risen sharply despite rising yields, a complete reversal of the normal relationship. This tells us that the market no longer believes higher yields reflect a strong dollar. Instead, they reflect a loss of confidence in the dollar's long-term stability. It's the same pattern we saw in the 1970s, rising yields and rising gold prices signaling the beginning of a new monetary era. The BRICS nations seem to have recognized this a long time ago. They saw America's gluttonous debt accumulation and they waited, knowing that once US debt became unsustainable, compound interest itself would become the trigger for the dollar's collapse. And that's exactly what's happening now. That dual rise, gold up and yields up, is exactly what we're seeing again today. Gold isn't just rising because of inflation, it's rising because trust is dying. Trust in fiat money, trust in central banks, trust in a system that promises everything but backs it with paper. Just like the 1970s, rising yields and rising gold are flashing the same warning, the beginning of a confidence crisis and the rebirth of sound money. As debt explodes, as wars expand, and as the printing presses return, gold is set to become the anchor of global trust once again. History doesn't repeat, but it rhymes. And the rhyme we're hearing today sounds a lot like 1971. Gold isn't just an investment anymore, it's a return to truth in a world drowning in debt. I really hope you got something out of this video. Thanks for joining me today, and I'll be coming out with more financial videos, as I think it's very important for everyone to be a part of the precious metals community. Signing off and see you next time.